Thank you for joining today. We're going to get started. Here we are in January, the second week of the year, third week of the year, whatever it is. What's going on with multifamily debt in 2024? That's the million-dollar question, and I would like to tell you I have all the answers, but I don't. We're going to go over some predictions today, look at some data like I always like to share, and then we'll circle back later in the year and see if I was right or wrong. So inevitably, somebody will be right and someone's going to be wrong. I'll probably hopefully fall somewhere in the middle. I did pull up a couple of my favorite sites to reference. I have the SOFR forward curve, and then I also have the CME watch group, which is a prediction of the Fed funds rate the rest of the year. I know if you keep up with any of this stuff, like I do, a lot of industry experts are predicting rate cuts in, maybe March, maybe June. I read something this weekend that they're not cutting it all this year, so I hope that's wrong. We'll go over this, go over my thoughts, and happy to answer any questions in the chat. I do want to have some interaction here. I want to see if some of y'all have bought a deal in the last couple of months, or if you're currently under contract on a deal. What kind of debt is working for you? Are you going floating rate, fixed rate, agency, debt fund, bank debt, and what that looks like. Happy to always share with others what we're doing and what you're seeing. We were pretty close on a deal recently, kind of back and forth between floating and fixed rate debt, with the treasuries kind of starting to come down in the last couple of weeks of last year and in the first part of this year. I think agency debt is getting closer to making sense on some multifamily deals. We'll kind of go through the options like I always like to do. The last few years, the best option has been debt fund. You get max leverage, floating rate, usually with a rate cap if you're smart. The rate caps have paid out well more than they cost historically. I think as the forward curve drops and rates start dropping, you're going to see that inverse. Rate caps are not going to pay out as much as they're predicted to. Those companies make money, they lose money. It kind of ebbs and flows. It's insurance, more or less. So debt funds are always there. I've seen some of the debt fund spreads come in a little bit. They're doing some SOFR plus 300 to 325-ish. I've even heard of some debt funds inside of 300 over SOFR for the right deal and the right borrowers, the right markets, the experienced borrowers. We have not transacted on one under 300. I would love to, but bank debt's an option. Usually lower LTVs there. I know banks really restricted the construction capital for multifamily in the last 18 months or so. That's kind of getting tight. Let's see. John threw out a deal here. 2 different bridge loans under contract. One in Dallas, good market. One in San Antonio. I was reading good things about San Antonio last week. One is fixed, 70% of purchase price, plus 100% of CapEx. There you go. 8.5 fixed rate, not a bad deal. It's SOFR 375. Yeah, his point, banks requiring a lot of deposits. I was in banking for about 7 years prior to this, and in good times, banks don't really care about deposits, and then when things get tight, all they care about is deposits. I was on a call with a banker last week, and I said, listen, I want a loan, you want deposits. Let's figure something out here. So usually 10% minimum of a loan is what a bank looks for, whereas a debt fund, agencies, that number is 0. So you got to weigh the pros and cons of putting some cash up to get some cash, but cost of doing business. Let's see. Amir has 2 deals, fixed rate agency. I like it. Pretty high LTV there at 5.5 fixed. I'm guessing that's a 10-year deal, and 80% at 695. Not bad. I think you're starting to see some more of the agency deals make sense with the treasuries coming in. Like I said, the 10-year was around 4%. It got down to mid to upper 3s a few weeks ago, and then crept back up. Let's see where it is today. We're at 403, not bad. One of the sites I follow, Pinsford, puts out a weekly email and is predicting the inversion of the yield curve. Traditionally, the inversion means the 10-year is below the 2-year. So right now, the 2-year is 542, and the 10-year is 2-year is 423, and the 10-year is 404. So that spread is tightening, meaning the yield curve is close to uninverting. Most recessions happen 18 months after the yield curve inverts. And it just so happens we are 18 months after the yield curve first inverted right now. So using historical data, the recession would about start now. I'm not a believer that we're that close to a recession. I know there was a lot of talk about it the first half of last year, and then the talk about soft landing came in. Last week, Thursday and Friday, we had a CPI and PPI reports that were, one was hotter than expected, one was cooler than expected for December numbers. Between now and March, there's only a couple more reports. So March is the next date where the Feds are expected to cut. There's a January meeting, but nothing expected there. On that note, let me go ahead and pull up all right. This is the Fed. It's a CME Watch Group website I've mentioned before. Basically, here's today where the Fed funds are currently 5.25 to 550. This is predicting 95% chance of nothing happening in the January meeting. There's always 8 meetings a year, just to kind of go over some high level stuff. 8 meetings a year. The next one's in March. Obviously, this predicts cuts at March and April of a quarter point each. March and May. Are we going to see that? I would like to think we do. Part of me expects to see maybe a cut in March and holding off in May. Somebody write down these predictions and let me know if I'm right or wrong. So I think we're going to see a cut in March. And the Fed has taken a stance recently, kind of wait and see. They like to wait and see until they like to cut. So I think we're going to see a cut in March, hopefully, nothing in May, and then another cut in June. I'm hoping one of these cuts, this is predicting 25 basis point cuts. Anything over 50% we'll call a prediction. So 1, 2, 3, 4, 5. They're predicting 5 cuts this year. I think we'll end up better than that. Probably more towards the last half of the year than the first part of the year. So I'm going to go ahead and throw it out there for the record. I predict 1 cut in March. I'm going to go ahead and predict a 50 basis point cut in June. Probably 25 for July, 25 for September, and nothing the rest of the year. So that should put us around 350, 375 or so. Lowering the treasuries, lower agency rate would be good for everybody. SOFR would likely have a similar trajectory. Here I have a screenshot of Pinsford's SOFR forward curve. There's other resources you can use to find a SOFR forward curve. SOFR's been at 535-ish for several months now. The forward curve tends to be a bit optimistic. It usually kind of has doing this, so hopefully it's lower than this. This has us ending the year at about 371. So that's a 150-ish basis point from today. Let me turn off the robot vacuum here 1 second. I think we'll end up right about there. I don't know if we'll follow this flow. This kind of spreads the cut out pretty evenly, starting in March or April, basically. This will bring direct relief to anybody with a floating rate loan, with or without caps. So let me go back to any questions on the SOFR forward curve or the CME Watch Group predictions here? And my Zoom is minimized. Here we go. Back to Amir's comment in the chat. I think I missed that. They're doing 5-year terms, switch from floating to fixed rate. We did that on a deal in December of 22. I think fixed rate is great long term. Sometimes it doesn't make sense. The floating rate usually gets you a little higher loan proceeds. You seem to have pretty good proceeds there. But so back to predictions for the year. I think we end up with a Fed funds rate in the 375 to 400 range. I think SOFR shakes out about 375. And what that's going to do, I think that's going to spur a lot of activity in the second half of the year. From a sales perspective, we've seen a lot of deals that we were second or third place on, and on the purchase side, come back. They call us a month later, 2 months later, 3 months later. Hey, are you interested in this deal? Because the buyer's backing out, likely because of debt. Could be insurance, could be equity. Equity's tough right now. But I think with the relief in the debt markets, especially the second half of the year, I think the activity is going to spike. Hopefully, cap rates kind of stay where they are or settle out. The closer cap rates are to interest rate, the better deal works. Or hopefully, interest rates are lower than cap rates at some point. But really expecting, like I said, the Fed funds rate 375 to 400 by year end. SOFR around 375 by year end would be a better market for everybody, unless you own a bridge company. So we are looking at any deal we look at, always evaluate floating or fixed. Your fixed options, obviously, agency is number one. The second options would be a life co. We've had some success in that in the past. Right now, life co proceeds are in the 55 to 60% range, and they don't want to go out past about 5-year terms. Bridge funds, typically 2 or 3 year term with extensions to 5 years. We've seen those around the 70% range for the right deal. If you take it back to 65 LTV, usually going to get a little bit better spread, probably closer to your 300 over. A max leverage deal of 70% is going to be a higher interest rate, a higher SOFR spread. John earlier mentioned he has one at SOFR plus 375. I'm guessing that's a pretty good leverage. So could be market based, could be deal based, a lot of factors there. But generally, best case for your Class A, mid major urban deal, we're looking at SOFR plus 300 to 325 for bridge money. Agency spreads, we're seeing the 5, 7, or 10-year Treasury plus 180-ish. There's some buy down options, usually up to about a point and a quarter in fees. You can buy the rate down about 29 basis points. Beyond that, it's just a point of diminishing returns. It doesn't make a lot of sense to keep throwing money to buy it down, in our opinion. So that can get you down to about a 150, 160 spread for the right deal over Treasuries. To Amir's point, if he's at 5.5, that's probably a 400 Treasury plus 150, something like that. Good deal. I mean, it's not a 3.5 or 4 or 4.5 that we've seen historically, but we're getting closer. So it's nice to see that the Treasuries come in a little bit. I think they're going to stabilize the next few months. 10 years can be right about 4, maybe high 3s. And then once the Fed indicates they're going to be cutting, or once they start cutting, hopefully in March, the Treasuries are going to drop. Your rate caps are going to drop. Rate caps based on the forward curve. The forward curve is going to drop. A lot of things will start to happen when the Fed cuts, be it if it is March or June or whenever it is. I believe this is recorded. We had a question there, so. All right. Anybody in the Q&A, any questions I can answer for you? I try to be up on all this stuff. I'm sure all of y'all are as well, but would love to be a resource any way I can on anything multifamily debt related, macroeconomic stuff. I know we got a political year. That's gonna be a curveball. I don't think anybody knows what's gonna happen there. It's gonna affect rates one way or another, I tell you that. So we have some, there's some stuff in Asian. There's, I think the Taiwan elections, you're having some bombings in the Red Sea, and all these kind of macroeconomic variables. You have the war in Israel, you have several other conflicts going on. Any of those could happen today and blow this whole economy up. I think it's the unknown that concern me the most. COVID was an unknown. 9/11 was a curveball. The 2008 recession, kind of should have seen that coming if you were watching the metrics. A lot of the metrics from then are similar to now. I would like to think our banks are in better positions. They have more liquidity. I think the markets are in better positions. A lot of the stock markets are at or near all-time highs. But some of the leading indicators of recessions are your consumer debt starting to creep up, your consumer savings is decreasing. You're starting to see more late payments on credit cards and car loans. Those are usually two of the leading indicators of personal cash flow getting kind of tight. I was reading an article that used cars are supposed to come down by 30% this year. I hope that happens. I'm a car guy, so we'd love to look at some cars at lower prices. So does anybody have any other predictions for this year or anything else I can address? Happy to see what other thoughts are. Again, my opinions are just my own. Let's see. Paul, Congress passed the tax bill. I did not see, I read a short article on that this morning. I did not see that it brings back 100% bonus depreciation. I would love to see that. That would be a big boom for acquisitions. And then examples of rate cap costs last year compared to present. I track our rate caps on a monthly basis, if not weekly basis. Prices from September to October to now, they've come down. And once the Fed cuts or indicates they're about to cut, those prices will significantly drop off. They're probably down 10 to 15% since Q4 last year, but they're still inflated. They're still very, very, very pricely caps. One of our deals, the initial rate cap, let's say 2 or 3 years ago, was $100 grand for a 3-year period. That cap recently was $300 grand for a 1-year period. And there's other examples of higher and lower, but those are in the money caps. They're paying out, so there's value there. Our banks adjusting with the changes. I've started to see some bank debt come down. I think in Q4, the interest rates, they were looking at mid-8s. I had a couple banks in the 9s. I think they realized the market's not there to support that kind of debt on a large scale. One of the comments earlier with deposits, banks are relationship driven. With deposits, you're going to get some better terms there. They have models that factor in. They're making money off your deposits and your loan as well. So you should be able to get some better rates that way. I think in bank debt should settle the year in the low to mid 6s. I mean 6.5 or so. I think we had a comment earlier. Somebody had one at 8.5. So let's see. Mark has a comment here. Multifamily starts down. They're down significantly, and they've been down for a while, directly linked to the availability of construction debt. So do you agree it may be a good time to buy in select markets knowing supply will be depressed in 25, 26? There's plenty of research out there on the supply forecast. I think there were a lot of starts in 21 and 22. 21 was Q4 21 was peak multifamily transaction volume for like a decade. And I think a lot of developers saw that there's a national shortage of like 400,000 housing units a year or something like that. So developers see these stats and then they start building these projects. Multifamily projects take 2 to 3 years, on average. The one that's coming online in January of 2024 was probably started in January 21 between permits, civil plans, and to CO, usually 2 to 3 years, depending on size and the market. I think we're getting close to a good time to buy. I think it's a good time to narrow down your markets and buy where you want to buy on your terms. It's definitely a buyer's market. I've seen so many deals come back around because buyers have backed out for whatever reason. So I wouldn't be pushed around with the price. I would buy a deal you like at a good basis in a good market. Never a bad idea. There's a lot of we are mostly in Sunbelt markets for multifamily. I mean, you have pretty much anywhere in Florida. You have a couple cities in Georgia, Charleston, Greenville. I like Charlotte a lot. Raleigh Durham has a lot of publicity. We don't have a deal there. It's come up on a lot of these top 10 lists for good multifamily markets. Nashville is always there, maybe a bit oversupplied. I think I saw the list, the most oversupplied markets, and Phoenix was up there. Orlando, no surprise there if you follow this stuff. The hottest markets a year or two ago are now going to be the most oversupplied markets. People look at the same data. I would find, as long as you're buying at a good basis in a good market, even at floating rate debt, fixed rate debt, whatever, debt's going to go down. You can refi later, but you can't change your basis later. So to Paul's point, hopefully bonus depreciation does come back. I would love to see that. I don't think we're going to see that. If I had to guess based on the current government structure, I think if things change with the elections, maybe that does come back. That would be a big spurring of activity. So let me see. We have what markets in California do you like? That's funny. We had an investor. He may be on here. He was at one of our events a couple of years ago, and he said, "Do you invest in the California market?" We said, "No." He said, "Okay, I'll invest with you." He lives there. I love California. My sister lived there for a decade. I visited many times. Great place to live, some areas. But as far as multifamily, I do not. We are not invested in California. I don't think we'll ever be. There's a lot of headwinds there politically. Lenders vary their spreads, the interest rate, based on markets. I mean, did they go to market they like? In a market they like, you're going to have a higher spread, lower spread, higher leverage deal. In a market they don't like, you're going to get a lower leverage, higher spread deal. So that's one thing to talk about when you're going to your debt broker, your lender, whoever it is. Say, hey, hypothetically speaking, if I had a 300 unit deal in Charlotte, North Carolina, brand new, what would that look like? And if I had a deal in Los Angeles, California, same deal, how would the debt look different? I ask that question a lot. My question is more, from like a Charlotte to like a smaller southeastern town. Even from a first tier to a second tier to a third tier town, you're going to see some differences in debt just based on the market. Nothing to do with guarantors, the deal itself. the top 50 lenders like to be in the top 25 markets. So in the Southeast, you're going to see Raleigh, Charlotte, Charleston, Greenville, Savannah, Jacksonville, Orlando, pretty much all the big cities in Florida. Texas is a great market. A lot of other Southeast markets, Nashville, Chattanooga, Knoxville. There are just some big ones in Tennessee as well. So I've been reading a lot of good things about Alabama as well. Tuscaloosa's up there. Sorry, not Tuscaloosa. A couple other cities in Alabama. I'm drawing a blank there, but good market. Hey, Ivy, be curious to see what you're looking at in California and how that compares to some other markets in the country just based on the locality of it. So any other questions today or any other comments from any of our listeners today? Happy to share my opinion, whatever little bit I do know, happy to share. And hopefully we can have another one of these in the last half of the year and look back on my predictions and see if we were right or not. So we have a question from what is the best way to find multifamily listings, especially in Cincinnati area? Networking. I can't emphasize networking enough. Meeting with the top multifamily brokers in the area, taking the lunch. You want to get on the top of their list. We have a whole acquisition team. That's all they do. My role ties in pretty closely with theirs. But that's relationship based so much. If you bought a couple deals from a broker and they know that you're buying deals in this market, one of the questions on a buyer's call that we get on, they say, hey, when's the last time you bought a deal? Tell us about the deal. How did the debt work out? If you have your debt lined up, or at least relationships lined up, that's a big factor. When a seller narrows the bidding pool to like 3 or 5 finalists, if you can go to them and say, hey, here's my debt, I have my equity here, I've bought 3 deals in the last year, you're going to probably end up at the top of that list. Not a lot of companies have bought deals in the last 12 months. If you have your equity in place, your debt in place, and you've transacted recently, and you've transacted with that broker before, or at least in that market or region, I think you're going to be at the top of the list. So take a broker to lunch, pick the brain. So anybody will likely share with you what's going on, especially if they get some free food out of it. So good questions there. I appreciate everybody's questions. Happy to answer any more if we can. Otherwise, there's another webinar I have, I believe in April or May. So I look forward to connecting with y'all again there. And let's cross our fingers the rates get cut in March, if not before. And we have a soft landing and not a recession. That's my prediction. So we're going to wrap it up. Thanks everyone for your time. Have a nice rest of your day.